Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
an exchange rate is the buying power of a currency, or how much of a second currency can be bought with an amount of the first currency. Not all currencies have the same buying power per unit, so knowing the exchange rate helps determine the value of a currency relative to other currencies. For example, suppose that the exchange rate of US dollars, or USD, to sterling pounds, or GBP, is 1.24. This means that it takes $1.24 to equal 1 pound. Put another way, if a US citizen traveled to the UK with $10,000 to exchange into pounds, they would get about 8,034 pounds. Exchange rates are often quoted in currency pairs, especially in forex trading, short for foreign exchange. Let's consider USD JPY, or US dollar versus Japanese yen. The first currency listed is called the base currency, and the second currency is called the quote currency. The price shown for a currency pair is how much of the quote currency can be bought with 1 unit of the base currency. If the price shown for USD JPY is 104.3, then 1 USD will buy 104.3 Japanese yen. Exchange rates may either be traded at the present exchange rate or at a future exchange rate. In a spot market, currencies are traded for immediate delivery or on the spot. In a forward market, currencies are traded for delivery at a future date. Some currency values are free-floating, meaning they rise and fall based on supply and demand in currency markets. Others are pegged to another currency, and governments do not allow their value to fluctuate beyond a certain margin with respect to that currency. For example, the Hong Kong dollar floats between a range of 7.75 to 7.85 for a single US dollar. If it moves beyond that range, then the Hong Kong Monetary Authority, or HKMA, intervenes to buy or sell its currency in international markets. Still, others have different offshore and onshore rates. The Chinese yuan, or CNY, for instance, has an exchange rate of 7.05 yen per $1 outside its borders, but 7.04 yen per $1 inside the country. A range of factors affect exchange rates. Some of them are economic strength of a country. The stronger a country's fundamental economic measures, such as gross domestic product and per capita income, the stronger its currency. Speculation. Currency markets are fertile ground for speculators because they allow quick profits. A big bet against or for a major currency can depress or appreciate its value significantly. Central bank policies. The fiscal and monetary policy of a country's central bank is an important factor affecting its value. For example, reducing the volume of currency in circulation can increase the country's exchange rate against other currencies. Let's hear from you. Can you guess the countries with a higher exchange rate than the US dollar? What do you think makes these currencies strong? Leave your answer in the comments below.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.